Hello, I'm Sebastian. Welcome to 9 Trees podcast. Today, I will summarize and review the book, Hot Commodities: How Anyone Can Invest Profitably in the World's Best Market by Jim Rogers, introduces readers to commodities as a powerful, often misunderstood asset class. Known for his global macro perspective and long-term market calls, Rogers frames commodities as both a source of opportunity and a practical way to understand the real economy, since raw materials sit at the start of nearly every supply chain. The book explains what drives major commodity cycles, why prices can swing violently, and how individual investors can participate without needing specialized industry access. It distinguishes between trading and investing, encourages a research-driven mindset, and highlights the importance of patience, risk control, and skepticism toward popular narratives. Rather than treating commodities as a niche for professionals, Rogers aims to make the market approachable, showing how everyday investors can use commodity exposure to pursue returns, diversify portfolios, and potentially hedge against inflation and currency weakness. The tone is direct and market-tested, emphasizing how real-world supply, demand, and geopolitics shape prices. I will give you key takeaways from this book. Firstly, why commodities behave differently than stocks and bonds. A central theme is that commodities are not paper claims on future cash flows, but real goods with physical constraints. Rogers emphasizes that commodity prices respond to supply disruptions, weather, storage limits, transport bottlenecks, and shifts in industrial demand, which can produce sharp, nonlinear moves. Unlike equities, where valuation can drift for long periods, commodities often mean-revert around production costs, yet they can stay above or below cost for years when capacity is tight or oversupplied. The book explains how commodities tend to surge when inventories are low and investment in new supply has been neglected, then later collapse as high prices encourage production and substitution. This cycle orientation helps readers avoid the trap of extrapolating recent trends. Rogers also connects commodities to inflation, currencies, and interest rates, arguing that monetary policy and the purchasing power of money are crucial drivers of broad commodity complexes. By clarifying these differences, the book equips investors to set realistic expectations about volatility, drawdowns, and the patience required for commodity bull markets to play out. Secondly, understanding commodity cycles. Through supply, demand, and inventories, Rogers repeatedly returns to a simple framework: watch supply, demand, and the inventory situation. Commodities can move for many reasons, but sustained trends usually require a tightening or loosening of the balance between production and consumption. The book describes how long lead times in mining, energy, and agriculture create slow supply responses. When prices rise, new capacity is not instantly available. The delay can extend bull markets. Conversely, once investment finally arrives, markets can tip into surplus and prices fall hard. Rogers underscores that inventories are the market's shock absorber and an early warning system. Low inventories increase sensitivity to disruptions, from droughts to strikes to geopolitical conflict, while high inventories dull the impact of news. Readers are encouraged to track visible metrics such as harvest conditions, rig counts, refinery runs, shipping flows, and policy changes that affect production incentives. The goal is not to forecast every short-term wiggle, but to identify when fundamentals are shifting. By focusing on measurable constraints and consumption trends, investors can form a probability-based view of where the market sits within its longer commodity cycle. Thirdly, ways individuals can invest in commodities and what to watch out for. The book outlines practical routes for gaining exposure while stressing that each tool comes with trade-offs. Futures markets offer direct access and high liquidity, but Rogers notes that leverage and margin can magnify losses, making risk discipline essential. For those who want simpler access, commodity-focused funds, indexes, and exchange-traded vehicles can provide diversified exposure, though investors must understand fees, tracking error, and how the product gains exposure to futures. A major caution is the impact of futures market structure, including contango and backwardation, which can create returns that differ from the spot price. Rogers also discusses investing in commodity-related equities, such as miners, energy producers, and agribusiness firms, which introduce company-specific risks, management decisions, and stock market sentiment. He encourages readers to match the vehicle to their goals and temperament. Long-term investors may prefer diversified exposure and modest sizing, while more active participants may use futures with strict position limits. Across all methods, Rogers emphasizes the necessity of liquidity, transparency, and a clear plan for exits, not just entries. Fourthly, risk management. In a market known for volatility, Rogers treats risk control as the price of admission in commodities. Because supply shocks and macro events can move prices abruptly, investors need rules that prevent one position from doing irreparable damage. The book emphasizes position sizing, avoiding excessive leverage, and respecting how quickly a market can gap beyond expected levels. Diversification across commodities is presented as useful but not a cure-all because many commodities can become correlated during inflation scares or global slowdowns. Readers are urged to separate conviction from exposure by scaling in, using predefined loss limits, and maintaining enough cash to survive adverse moves. Rogers also highlights behavioral risks, chasing hot stories, confusing a trade with an investment, and holding on simply because a position once worked. He encourages a research-driven approach that seeks disconfirming evidence, such as new supply sources, technological substitution, or policy interventions that can change the fundamental picture. Overall, the message is that big commodity bull markets can be lucrative, but only for investors who can stay solvent and calm through violent swings, headlines, and temporary reversals. Lastly, global forces that move commodity prices, politics, money, and demographics. The book links commodity performance to large-scale global forces that reshape consumption and production. Rogers pays attention to geopolitics because resource markets are often concentrated in specific regions, making them vulnerable to sanctions, wars, regulatory shifts, and nationalization fears. He also ties commodities to monetary policy, arguing that currency debasement and loose credit can lift nominal prices, while tight policy can pressure demand. Demographic trends and economic development are another pillar. As populations urbanize and incomes rise, diets shift, energy use increases, and infrastructure demand expands, influencing everything from grains to metals. Rogers encourages readers to think internationally rather than through a single country lens, noting that marginal demand or supply frequently comes from unexpected places. He also points out that government actions, including export bans, subsidies, strategic stockpiles, and environmental rules, can overwhelm purely economic models in the short run. By mapping these macro drivers, investors can better understand why commodity bull markets often coincide with broader regime changes and why the most important information sometimes sits outside traditional financial news. In conclusion, this book is best for individual investors who want to broaden their understanding beyond stocks and bonds, as well as professionals seeking a clearer framework for evaluating commodity cycles. It suits readers who are curious about how real-world constraints like weather, mining lead times, energy infrastructure, and geopolitics translate into market prices, and who prefer a fundamentals first perspective over purely technical trading. The practical benefit is twofold. You gain tools to think in cycles and probabilities, and you learn how commodity exposure can diversify a portfolio, potentially protect purchasing power during inflationary periods, and reveal early signals about the global economy. Compared with many investing guides that treat commodities as a speculative sideshow, Rogers argues for their central role in long-term macro investing and explains why major commodity bull markets can last for years. The book stands out for its clear emphasis on supply, demand, and inventories, plus its candid attention to risk and investor psychology. If you want an accessible entry point that connects commodities to everyday economic reality while still offering actionable ways to invest, it is a worthwhile buy. If you would like to support Jim Rogers, you can buy the book through the Amazon link I've provided in the podcast description. After reading the book, please let me know what you think and share your thoughts. See you around.